In our last video, we discussed what the price to earnings ratio is, how investors use it, and its drawbacks. We also learned that we can simply not use the price to earnings ratio all of the time. And in this video, we are going to dive deep on when you can use it and when you shouldn't, so you can confidently start valuing businesses on your own. So with that being said, let's just dive right into the video and into all of the juicy stuff. And we're going to head over here to Stock Unlock's freeform tool, because one of the best times to use the price to earnings ratio and when it is the most useful is on more mature businesses that have a long history of having actual earnings. Right here, a good example of this is Apple. Here we can see that Apple's price to earnings ratio hasn't done anything too crazy over the past decade. We can see that over here, the price to earnings ratio is about 19, then it got down to about 10, and then it spiked all the way up to about 30, well, actually about 38 in 2020. But we can see that there's no clear glaring spikes up to hundreds or, thousands of price to earnings ratios. So for Apple in specific, I think that the price to earnings ratio could be a good metric because it has been consistent throughout history. However, before I started recording this video about 15 minutes ago, I was trying to look for more good examples of companies with a solid price to earnings ratio history, and I was actually having a hard time finding good examples. Right here, we're taking a look at Coca-Cola. We can see that Coke's price to earnings ratio is about 25, 24 in about 2016, and then it spiked all the way up here to about 162 in 2018. And as we learned in our previous video, this is most likely because Coca-Cola had some non-cash expense that caused the earnings to decline, which in turn caused the price to earnings to absolutely skyrocket. This is the case for a lot of stocks in the market. Even Procter & Gamble, I was just taking a look at this one. And we can see here that Procter & Gamble's price to earnings ratio went from about 14.6 in 2017 all the way up to 76 in 2019, and then dropped all the way back down to 24 today. As I said again in our last video, when you see price to earnings ratios like this and they're spiking and being volatile, it kind of is hard to come to a conclusion about the company's value or the stock's value because there's just so much inconsistency with how the stock has been valued historically based on its earnings. Then the question is, when is the best time to use the price to earnings ratio? Well, again, as I said, it's usually on more mature businesses with a long track record of consistent earnings like Apple. And the other time that I personally use the price to earnings ratio over everything is on financial stocks like banks and insurance companies. This is because these businesses report their earnings very consistently, and they tend to have quite consistent earnings versus other profitability metrics like the price to free cash flow or the price to operating cash flow. For example, we're going to take a look here at JP Morgan over the past decade. And here we can see that JP Morgan's price to earnings ratio relatively is quite consistent and stable. I mean, back here in 2012, JP Morgan had a price to earnings ratio of about 7, and then the highest it got over the past decade is about 16 in 2018. So JP Morgan's price to earnings ratio has only gone from about 7 to 16 over the past decade. That's a pretty low range. And we can see here that it's pretty consistent, it's pretty reliable. So since this is a consistent ratio for JP Morgan in specific, we can take a look at the price to earnings ratio today of 10.4 versus the company's history and get a better idea and a clear idea of if the stock is cheap or expensive right now. Also on Stock Unlock, what we do here is we show you the average price to earnings ratio over the selected time frame that you have in the freeform tool. So right here, we can see that JP Morgan's average is about 10.8 over the past decade. Currently, the stock is selling for a price to earnings ratio of about 10.4. So it's selling right around its historical average over the past 10 years. And that is really how I like to use the price to earnings ratio, especially on these financial stocks like JP Morgan. Then the question is, why don't free cash flow metrics work for financial stocks like JP Morgan? So what we're going to do is take a look at JP Morgan's net income right here. And we can see that for the most part, this is a pretty stable line. It has some ups and downs, especially over here in the Great Recession when that happened. But we can see that for the most part, this is a pretty stable line that is going up and to the right. Well, now let's take a look at JP Morgan's free cash flow. And we can see that the free cash flow is absolutely all over the place versus the bank's net income. And the reason for this is because banks make money through taking in deposits and then loaning those deposits out. So when the bank takes in a large amount of deposits, that is technically reported as free cash flow coming into the business. And then when the bank loans out that money and to generate higher, interest rates and returns on that money, because banks are essentially just large lenders, then they have to report that as a cash outflow for the business. So these massive spikes here in free cash flow and then the massive declines in free cash flow for banks really just depends on what their deposits are doing. Are their deposits coming in, or are deposits net going out for the year or for the quarter? Since that happens, you can see that it creates a very volatile free cash flow figure, whereas the net income is like this nice, steady, clear line through this chart. So when I take a look at this, net income is clearly much more consistent for JP Morgan, and this is the exact same story for pretty much every bank that I've ever taken a look at. For example, Equitable Bank is a stock that I personally own. It's a smaller cap bank, but take a look at this. The net income line is nice and consistent, and then the free cash flow is absolutely all over the freaking place. So when I'm taking a look at a business, what is the most consistent and reliable profitability metric for that business in specific? And again, banks and insurance companies and really all financial companies typically have the net income be the best metric to track, or the price to earnings ratio, because the net income is much more consistent than the free cash flow or operating cash flow metrics. I mean, let's take a look here. Let's take a look at Equitable Bank's price to earnings versus its price to free cash flow historically. This is going to be a wild chart, I think. Yeah, okay, so we can see the price to free cash flow right now is sitting at 182 versus a PE of 7.4. And all the way back here, price to free cash flow was 2. So Equitable Bank's price to free cash flow has gone anywhere from 0 to 182 over the past decade, whereas if we remove the price to free cash flow, the PE ratio over the past decade here has gone anywhere from, what is this, 4.5 to about 10. So it's a much more consistent and reliable metric. And that's really how I would use the price to earnings ratio. And that's how I use it in my own investing to come to conclusions. So again, to wrap up this PE ratio, I like to use it on more mature businesses that have a history of stable earnings. And I like to use it especially almost solely on financial stocks like banks and insurance companies, because it just makes the most sense logically. Actually, I have a lot more that I want to discuss about the price to earnings ratio, because I'm really going to hammer this point home. Again, because the price to earnings ratio is like it's the metric that almost every investor looks at and talks about. But in all honesty, I strongly believe it is not the best metric all of the time. So what we're going to do now is actually take a look at Shopify. This is quite a large business, and it's a pretty well-known business in the stock market. So what we're taking a look at right now is Shopify's third quarter 2021 earnings for basically the 3 months ended September 30th, 2021. And what we can see right here on their income statement, well, first off, let's take a look at the revenues. So right here, they had revenue of about 1.1 billion for the third quarter of 2021, okay? Then they had a total other income of 1.3 billion for the third quarter of 2021 versus the prior year in 2020, they had other income of about 136 million. So their other income year over year increased by about 1.2 billion, and their other income reported was more than the revenue that the business generated, okay? For the 9 months ended September 30th, 2021, Shopify reported other income of $3.375 billion versus $153 million the prior year. So year to date, for when they reported, they had an increase of other income of over $3.1 billion year over year. And again, their other income alone was more than the revenue that the business generated. So then I went and I took a further look through the company's financial statements. And right here on the cash flow statement, what the cash flow statement does is it removes all of the non-cash additions or expenses from the business to show you the actual cash flow or profits coming into the business. So right here on the cash flow statement, we can see that this massive number right here, about $3.4 billion, was net unrealized gains on their equity and other investments. Now remember, in our previous video, I clearly showed you that due to a change in accounting rules in 2018, businesses have to report unrealized gains or losses, essentially fluctuations to their investments, every single quarter as either net income or an expense against net income. That is exactly what we are seeing right here on the cash flow statement. So on the cash flow statement, we are removing that unrealized gain on those investments, which is reported on the income statement. Now, what's also interesting is we can see that the actual net cash provided by operating activities, or the actual amount of cash that Shopify's business generated, was about $244 million, which is significantly different from the net income that they reported of over $3 billion. So then I went further down in Shopify's financial statements, and this says, In the 3 months ended September 30th, 2021, we had other income of $1.34 billion compared to other income of $136 million in 2020. The increase was driven by an unrealized gain on equity and other investments of $1.34 billion. So basically, all of the company's net income for the quarter was an unrealized gain on their investments, or essentially investment values fluctuating in the stock market. This is why I do not like to use net income a lot of the time, because again, Shopify's entire net income or earnings was just an unrealized gain on an investment, which would cause the company's price to earnings ratio to look a lot lower and potentially make the stock look artificially cheap. Now, again, it says here in the 9 months ended September 30th, 2021, we had other income of $3.375 billion compared to other income of $153 million in 2020. The increase, again, was mainly driven by unrealized gains from Affirm and Global E investments totaling about $3.36 billion. So then I have a screenshot right here of Affirm's price over the past year, and we can see that the stock has dropped 92% over the past year. So in 2021, when Affirm was running crazy like this and the value of Affirm was going up, Shopify, since they own Affirm shares, reported a massive gain on their investment, which they also reported as net income. Now Affirm stock is down 92% from the all-time high, and what this means is that now that Shopify's investment has lost value, even though they haven't sold it, they're going to have to report that against net income, and it's going to make it look like the business has negative earnings and is in fact losing money. So then I went and I took a look at Shopify's other income and net income for the second quarter in 2022 after Affirm's stock has dropped so much. And again, remember, Shopify owns Affirm's stock, so their investment value dropped essentially. And right here we can see that the other income expense now is negative $1 billion on the quarter, and year to date in the second quarter of 2022, Shopify now had to report a negative $2.5 billion other income figure on the income statement, which caused their net income to be negative $2.6 billion. So what I'm trying to show you here is that Shopify's net income went from positive $3 billion in the third quarter of 2021 to negative $2.6 billion by the second quarter of 2020, not even within a year, all due to the company's investment value in Affirm. Does that tell you anything about the company's profits? Does that tell you anything about how much cash Shopify's actual business is generating? No, in my opinion, absolutely not. What this number shows you, the earnings figure shows you for Shopify, is just how much their investment values is moving around. And this is not just with Shopify. This is also with some major companies like Amazon. So I went through Amazon's fourth quarter 2021 earnings, and right here, the Amazon for the fourth quarter last year says net income increased to $14.3 billion for the fourth quarter. However, net income includes a pre-tax valuation gain of $11.8 billion included in non-operating income for our common stock investment in Rivian Automotive. $11.8 billion worth of Amazon's $14 billion of net income last year was due to an unrealized gain on Rivian stock. Well, Rivian stock has been absolutely decimated over the past year. And then by the first quarter of 2022, literally just 3 months later, Amazon reported a net loss of $3.8 billion, and the net loss included a pre-tax valuation loss of $7.6 billion due to their Rivian Automotive investment. So in the fourth quarter of 2021, Rivian's stock was up, and that caused Amazon to report an $11.8 billion gain to their net income. Then literally 3 months later, Rivian's stock price was down, and since Amazon is a shareholder in Rivian, they had to report a $7.6 billion loss on this investment, literally just 3 months later. That's over $19 billion worth of a swing in earnings just due to what Rivian's stock is doing. And that has nothing to do with Amazon's actual business or profitability. So again, in my opinion, I think that earnings or net income can give you a completely wrong idea of a business's value and its potential profitability. I mean, what we can do right here is actually go take a look at Shopify on our freeform tool, and we can take a look at their price to earnings ratio, because when their investments were doing well, Shopify's price to earnings ratio got all the way down to 23.9. And then literally within a few months, it spiked all the way up to 409. So if you're trying to value Shopify based on its earnings, what are you going to do? When is the time to buy it? Is the time to buy it when its investments are doing well with a price to earnings ratio of 23.9, or when the investments are doing bad and it has a price to earnings ratio of 409? So in my opinion, there's really no conclusion that you can come to there from taking a look at Shopify's earnings and Amazon's earnings in general as well. We just beat the price to earnings ratio down hard. Okay, so now we're going to move on to the price to free cash flow metric, which is one of my absolute favorite metrics for valuing any business outside of financials. Because remember, financials, free cash flow metrics simply do not work that well, as we saw with JP Morgan and Equitable Bank. So outside of the financial sector, I always use price to earnings ratios inside of the financial sector. So then we're talking about outside of that sector now. I like to use the price to free cash flow almost all the time. And I'm going to show you a few examples right here. Let's head back over to our freeform tool and let's take a look at Microsoft. And we're going to take a look at Microsoft's price to earnings ratio versus its price to free cash flow over the past decade, and which is right here. So this dark blue line right here is Microsoft's price to earnings ratio, and then the light blue line is Microsoft's price to free cash flow ratio. Now take a look at this chart and take a look at which ratio is more consistent, which one is more reliable. Well, in my opinion, it is the price to free cash flow metric. Throughout history, it has been much more steady, much more consistent, and much more reliable. And as we saw with Shopify's cash flow statement, the reason for this is because the cash flow metrics take out all of those non-cash expenses and additions to the net income. So basically, the cash flow metrics show you how much cash the business is actually producing, how much profits are actually coming in. And you can see here that this metric tends to be a lot more consistent and reliable, even for the largest companies on the planet like Microsoft. I believe this is the exact same thing for Google. And yes, it is the same thing. Google's price to earnings ratio got all the way up to 63 in 2018, but the price to free cash flow at the same time was about half at 33.7. And throughout history, it has just been a much more steady metric. This is even the same thing with a company like Coca-Cola. If we take a look at Coca-Cola's metrics, we can see that the price to earnings ratio spiked massively in 2018, but the price to free cash flow remained quite consistent and stable and steady. I believe this is even the same for a company like Procter and Gamble. So, yep, it is the exact same story. So you can see that the free cash flow metrics are just much more steady, much more consistent, and that is why me, as an investor, I prefer to use these metrics much, much, much more because they're just more reliable and steady. So that is when I like to use the price to free cash flow. Basically on almost any other business outside of the financial sector, I will prefer the price to free cash flow metric. Now, there are times where I do not prefer the price to free cash flow metric, and Amazon is a perfect example of this. What the price to free cash flow metric does is it takes the operating cash flow that the business generates, and the operating cash flow is the amount of cash that the business's operations actually generate. So it's how much cash comes in from the operating activities. Then what happens is the company subtracts its capital expenditures to find the free cash flow. Now, capital expenditures include investments in growth. So for a company like Amazon, they never want to pay a dividend. What Amazon wants to do is invest as much money into future growth as it possibly can, always. What that means is Amazon's free cash flow is always low or it's negative. So basically, companies that like to invest in future growth all of the time, I like to use the price to operating cash flow figure because these companies are always going to have low free cash flow and they're always going to have very high price to free cash flow metrics. And Amazon, again, is a perfect example of this. So we're going to take a look at Amazon's price to free cash flow throughout history, and we can see that it is all over the place. Back here in 2012, it was 40. Then it spiked all the way up to 700 by 2013. Then it got down to about 40 in 2016. By 2018, it was back up to 150, then back down to 44 in 2019. And then in 2021, it was back up to 260, and now it's zero because the company is generating no free cash flow. So for Amazon, this price to free cash flow is all over the place. There is no real value that I can get here as an investor by taking a look at this. Because when should I buy Amazon stock? Should I buy it when the price to free cash flow is 600, or should I buy it when the price to free cash flow is 30? What kind of conclusion can I get there? So what I did, or what I like to do, is take a look at the price to operating cash flow metric for Amazon. And we can see here that the light blue line is much more consistent and reliable. So let's remove the price to free cash flow. And now we can actually get a better representation of how Amazon has been valued throughout history. And even just logically, it makes sense to look at Amazon's price to operating cash flow versus its price to free cash flow, because Amazon's entire business model is to invest as much money into growth and capital expenditures. So really taking a look at the price to free cash flow doesn't even make sense on a logical perspective as well. So I like to take a look at the price to operating cash flow for a business like Amazon because it's always investing in growth and it's a much more consistent metric. And this is how the market has been valuing Amazon historically. It has not been using earnings. It has not been using price to earnings. It has not been using free cash flow or price to free cash flow. It has been using price to operating cash flow. Let me show you. So over the past decade, Amazon's price to operating cash flow, the lowest it has ever got, was here in about 2015 when it was selling for about 20. What I noticed with Amazon stock is the market always buys up Amazon stock. Yeah, whenever Amazon stock gets to a point where it's trading for a price to operating cash flow of 20, that is where the market buys it up, and that is where it has historically bottomed. I'll draw a line on the screen here in Adobe, in my video editing program, and I'll draw a line right at the price to operating cash flow of 20 so that you guys can see whenever Amazon stock hits this price, the market tends to buy up shares of Amazon, and that's like the floor. Now, on the other hand, the highest it's ever gotten was about 45 right here. So basically, Amazon's price to operating cash flow throughout history has had a range of about 20 to 45 on the high end, which is a much, much more reliable and consistent price ratio to track Amazon with than its price to free cash flow or price to earnings. So when I'm a shareholder of Amazon, by the way, and whenever I am looking to value Amazon, I follow the operating cash flow metrics and the price to operating cash flow because this is how the market has been historically valuing it. And this is the most consistent price or the most consistent metric to track for Amazon by far. So anytime, and it's funny because anytime anyone talks about earnings for Amazon, I'm just like, why are you talking about Amazon's earnings? That is not the metric to use, because when you're talking about Amazon's earnings, what you're actually talking about is what is the Rivian investment doing? Because that's what Amazon's earnings are. It's all just Rivian's stock price going up and down. So if you're going to buy Amazon at a high price to earnings ratio, then you're just buying Amazon when the Rivian investment is doing bad. If you're buying Amazon at a low price to earnings ratio, then you're buying Amazon when the Rivian investment is doing good. Does that tell you anything about the business? No. Does it tell you anything about the business's profitability? No. So in my opinion, I like to use the operating cash flow. Those are all of the reasons why, and I believe I've made a very strong point here. Right now, we can see Amazon's price to operating cash flow is sitting at about 23.4, which is on the lower end of how the stock has historically traded. We can also see that the average price to operating cash flow has been about 29 if we want to round up over the past decade. What this tells me is that right now, Amazon is trading for a lower price to operating cash flow than it has historically, which suggests to me that the stock is looking attractive right now. And in my opinion, not financial advice, I do think that Amazon is on the cheaper end right now because it's selling near its historical lows in terms of its operating cash flow. So I think that is the best metric to use, the price to operating cash flow, for businesses that are constantly investing in a lot of growth and in a lot of CapEx. Another sector that does this is utility companies. Utility companies invest a lot of their free cash flow or their operating cash flow into future growth. So what I like to do with utility companies is use the price to operating cash flow as well. Fortis, which is one of the best utility companies in Canada, is a perfect example of this. What we're going to do is take a look at the price to free cash flow versus the price to operating cash flow. And what do you know? Fortis never has any free cash flow because the business is literally always investing as much money as it can into more CapEx and into more utility assets. This is one of the ways that the company actually makes money because utility companies are funny. The more money they invest into more utility assets, the more money they actually get from the government and the more profits they can make. So utility companies a lot of the time have negative free cash flow. And that is why Fortis's price to free cash flow is always zero. So you can't really use the price to free cash flow on a business like Fortis because it's always investing high amounts of capital into CapEx. So because of that reason, I like to use the price to operating cash flow on this business. And we can see that this has been a pretty dang consistent metric over the history of Fortis. And you can get a good idea of when to buy this stock when you take a look at this metric. This goes for a lot of utility companies. So if it's a utility company, I like to use the price to operating cash flow as well, not price to free cash flow and not price to earnings. And that's when I like to use all of my price ratios. So to summarize everything, price to earnings ratios, in my opinion, are the best to use on financial stocks like banks and like insurance companies. Price to free cash flow I use on basically every other business, especially if it is a mature business. And then price to operating cash flow I will use on the utility industry or businesses that are investing a large amount of capital into capital expenditures or CapEx and future growth. So that's like my mental brain outline. But in general, if you don't know what kind of business you're looking at, or you don't know which price ratio to use or which one's the most consistent, what I do is I just enter in the price to operating cash flow, the price to free cash flow, and the price to earnings into our freeform tool here on Stock Unlock. And I just try to visually see like which metric is the most consistent and the most reliable, like which metric is the market tracking for this business. And then once I figure out, okay, well, this is the metric right here that the market seems to track, then I use that metric for that business in specific. And sometimes, you got to play around with the freeform tool and find that metric on your own. But that's just the game of investing. Everything isn't given to you. And as Warren Buffett says, well, he's historically said that you cannot look to one metric for every single stock and use it and say, you know what, this is the one metric that's going to tell you when a stock is cheap. That's the same for earnings. That's the same for free cash flow. That's the same for operating cash flow. Any other metric is going to be the same. You cannot look at one number and say, yep, that is a cheap stock in the market. You kind of got to do some digging on your own and think about it a little bit deeper. Now, the last thing that we have to talk about in this video, because I know I'm going to be asked, is the price to sales ratio. Now, my opinion on the price to sales ratio, I'm just going to be blunt and honest with you guys. Don't use it. I never use this ratio. I think it is a waste of time. And I think that it leads to a lot of really bad conclusions when you're investing. I've seen a lot of other YouTube channels over the past couple of years use the price to sales ratio. They say that this is the ratio to use. Everyone uses this ratio. And it's absolute garbage. I never use it. I don't think anyone should use it. I'm going to tell you, you probably shouldn't use it either. And I'm going to explain to you exactly why right now. Right here, we're taking a look at this company, Canopy Growth, CGC is the ticker. We're taking a look at its price to sales ratio. Well, I'm going to zoom into about 2018, okay? Or about 2020. So we can see the price to sales ratio has gone from anywhere from 16 to 177 or 176, whatever. And now it's all the way back down here at about 19 in 2020. So we're looking at 2015 to 2020 right now. So if you're taking a look at the price to sales ratio on its own in a bubble, okay, you're taking a look at just the price to sales ratio. You may see that, throughout history, the lowest this stock has ever gotten was here in 2016 at a price to sales ratio of 16. Then it spiked to a price to sales ratio of 176 in 2018. And then it fell all the way down to a price to sales ratio of about, 17 in 2020. So if you're taking a look at just the price to sales ratio in 2020, in April of 2020, you may have been thinking, well, the price to sales ratio is right near its historical lows. Like the last time the stock was selling this cheap was in 2016. So now the price to sales ratio is all the way back down to 17 in 2020. This must mean that the stock is a good buy because relative to its sales, it's freaking cheap. Let's load up on it, right? Nuh-uh, not at all. This company's price to sales ratio is now selling all the way down here at 5.9. So back here when it was selling for, 17, clearly that did not mean it was a good buy because the price to sales ratio has gone all the way down. Well, now you may be looking at the price to sales ratio today of 5.8 and saying, you know what? This is really low. It's selling for the lowest price to sales ratio it's ever sold at. This must mean that this stock is an incredible buy. Its price to sales ratio is at an all-time low. Not at all. I completely disagree. Let's go and take a look at Canopy Growth's fundamentals here. Let's go and take a look at its Stock Unlock insights. And we can see right here that this company's profitability is negative. It literally has a negative gross margin. It has a negative 120% free cash flow margin, and it's lost over $500 million in the past year. But here's the thing, is the price to sales ratio only shows you the company's revenue. It does not tell you anything about the company's profits or anything about the company's margins. And when you're investing, what matters is thinking about how much cash that business can return to you as the investor. So if the company is losing money and it's super unprofitable, it has negative margins, then in my opinion, the revenue isn't really worth that much. So what is the price to sales ratio going to tell you in terms of what actually matters, which is the profits for the business? And there are countless examples of this. Let's take a look at another example right here, which is Hexo. This is the exact same story. Let's zoom into about 2020 and let's zoom into about 2017. So if you were taking a look at Hexo right here from 2017, price to sales ratio of 23 spikes all the way up to 341. Now it's all the way back down here by 2020. It's got a price to sales ratio of 5. So in 2020, you may have been looking at the stock and been like, you know what, man, price to sales ratio is at an all-time low. Let's buy this stock. It looks super cheap. Well, let's go and take a look at Hexo now. So if you were using the price to sales ratio, you would have bought Hexo probably somewhere around here at about $3 a share. And you know what? You would have made some money right here for a short amount of time, but let's zoom out now. So if you were buying Hexo right here at a price to sales ratio of about 5, you're now down about 93% on your investment. And why is that? You bought the stock at a low price to sales ratio. Well, it's because this company is losing so much freaking money. It's got a negative gross margin, it's unprofitable, and in the past year, it's lost $151 million. So even though you know the company's priced relative to its sales at an all-time low, it doesn't mean that it's a good investment because the company is losing money, even though it's generating revenue. And if we take a look at our freeform tool and we zoom out to 2022, it's now got a price to sales ratio of 0.6. So if you were buying the stock back here with a price to sales ratio of 5, even though it's the lowest the stock has ever been, it doesn't mean it's a good buy, in my opinion, because the stock is losing so much freaking money and it's not unprofitable and it's going to burn all of your cash. Now the stock is selling for a price to sales ratio of 0.6. Is it a good buy? In my opinion, no. Why? Because it's generating no profits for you as the investor. And if the company is not generating profits, then you have to ask yourself, how is it going to stay in business? How is it affording to pay its employees? How is it affording to pay its utilities? You know, if it's losing money, how is it going to do that? It does that through either raising debt or doing dilution, which both of those things destroy shareholder value. Even though this stock is selling for a price to sales ratio of 0.6, no, I would not be buying this. Yes, the stock is being valued higher relative to its history, but it's got no profits, and profits are what matter. And price to sales ratios tell you nothing about the company's profits. So personally, I do not use the price to sales ratio ever. And you guys, I have so many examples of companies like this. Let's go and take a look at Tattooed Chef now. So here we can see that Tattooed Chef has had a price to sales ratio of 11.8 in 2021. Now it's dropped all the way down to 0.364. So any investor may be looking at Tattooed Chef now and saying, you know, the price to sales ratio right here is at an all-time low. Should we buy Tattooed Chef stock? No, not in my opinion. So let's go and take a look. Tattooed Chef's insights. It literally has 1.4 months left of cash. So the company is literally going to run out of cash within the next couple of months. And the company's profitability is non-existent. It's literally losing money all over the place. And in the past year, it's burned over $120 million. And now since it's burning so much cash, it's only got 2 months of cash left. So yeah, the price to sales ratio is at an all-time low, but in my opinion, that does not mean that the stock is a buy. It is incredibly risky. You guys, I could go on for days about this. We got another stock right here. Boom, Skills. So Skills had a price to sales ratio of 43 in 2021. Now the price to sales is sitting at 1.1. Again, price to sales is at an all-time low. Does this mean the stock is a good investment? No, in my opinion, no. I'm not a financial advisor. Don't go and buy this stock just because I'm talking about it. In my opinion, I think that this stock is not a good investment, even though the price to sales ratio is sitting at an all-time low right now. Why? Because the stock is losing so much freaking money. It's not making any money at all. It burned over it's burned about $250 million in the past year. Its revenue and everything is decreasing, and its fundamentals do not look that good at all. Also, this stock, if you bought this stock any time in the past year, I mean, it's just been consistently selling off, and the stock is now down about 98%. So, you know, you may have been buying it right here because you thought the price to sales ratio was at an all-time low of 2.26 or 2.6, but I'm telling you, the price to sales ratio can go much lower if the business is losing money. So to put all of that into perspective, again, you guys, I have dozens of examples here. I probably have over 100 examples that I could find of companies where if you were valuing it based on the price to sales ratio, you would have lost a ton of freaking money because the companies are not generating any profits for shareholders. In conclusion, price to sales ratio, in my opinion, I never use it. I think that no one should use this ratio. I think it's a dangerous ratio to use. And it's a ratio that I see a lot of other YouTubers and investors using. And in my opinion, I think it is really not a good ratio to use because it tells you nothing about the profit potential of the business, how the business is financially, or anything like that. In conclusion, don't use the price to sales ratio. That is why. But that is all the ratios that we're going to talk about here. This is going to be a long freaking video, but I really hope you guys found it insightful and helpful and helps you understand when you should use certain price ratios on which businesses and how you can value businesses better. If you enjoyed this video, please remember to leave a like on it. And if you're interested in checking out our Stock Unlock platform here, then you can go and get a 14-day free trial, totally risk-free. You don't even need a credit card. And you can come and check out all of your stocks. You can come and check out every single one of your stocks insights right here. Check out its financial health, check out its growth, check out its profitability. You can clearly see if your business is losing money, how much money it's losing, and how risky your business is with our Stock Unlock Insights scores. you can come and do this for totally free. You can come and make a 14-day free trial, literally check out all of your stocks, and then not even have to pay for the platform. All right. That's what I would do if I were you. I think that you should pay for the platform because I make it, and I think this is a fantastic platform. But seriously, you can tell me to shut up. You can come and get your 14-day free trial. Come and check out all of your stocks. See if there's anything that you should know, all of the highlights, lowlights, anything you should know with our insights. And then you can make up your mind if you want to pay for the platform or just not. That's going to wrap up the video, everyone. Thank you so much for watching. If you enjoyed, please remember to leave a like. If you want to see more content like this, hit the subscribe button and make sure that you turn on the notifications with the bell icon so that you can see when we post future videos. But that's going to wrap up everything for me. Thank you guys so much for watching. I truly do appreciate it, and I really hope to see you all again in our next video.